Markets are effectively pricing right now for global growth momentum to be completely unaffected by the tariffs. But as you said, that's not the situation that we're in. So the markets seem to be betting, or we've seen that they're rolling over, it's the taco trade, they're going to all unwind it. And what we're learning from these deals is, A, the tariffs are here to stay. So currently you've got additional, basically, pressure on the US private sector, additional tax payments, tariffs is a form of tax, of $250 billion. Once all the tariffs that are currently in place are basically paid, then you go into $400 billion. Think about this. So far, corporates have not passed this on to consumers, as we've seen in the May CPI. So you've got a profit pool in the US of $3 trillion. That's total profits. And you're paying out $400 billion in additional costs. That's a 10% margin squeeze. But if you look at margin expectations, they're at all-time highs. So the market has not yet taken this seriously. And what we learned from the Vietnam deal is, if anything, the tariffs are going to go up from here, not down, because they're additional. Basically, the market, our economists expect everybody's paying 10% out of China. You're not paying 10%. You are basically running at a higher rate. So if anything, the risk is that the tariffs will even be higher after July 9th. The market is not pricing that.
And when you think about where we are in terms of European equities, therefore, what do you expect for the next week?
Yeah. So there are two elements. There's the trade war on the one hand, and what are the tariffs you get, but also what is the impact on the actual macro data of the tariffs you've already. So if you look at the Atlanta Fed tracker, final demand in the US, that's effectively consumption plus investment, was running at 2 to 3% over the last 3 years, and the market is saying, wow, this is so strong, it's driving global growth, it's the most important puzzle piece of the global economy. Now you've slowed already in the second half, in the second quarter, to 1%. The final demand growth is slowing very sharply. The market is not yet taking that seriously. Look at the ADP report yesterday, showing negative private. I think the chances are very high you see a negative print on payrolls today. Trump has already seen the numbers, and you've seen his tweet overnight. He says Powell should resign immediately. So we're going to see what that's going to show. So I think the data is going to get weaker from here. Our economists think that final demand growth is going to slow to mildly negative over the coming months. And that is enough to scare the market. If on top of that you get more tariff increases, that is simply, with equity risk premium at the moment at a 20-year low, the market is not prepared for this.